Hello, welcome to this video about short-term business decisions, which is chapter 10 in our textbook. So when we're done studying this chapter, you should be able to identify relevant information. So this is really the key to this whole chapter, which is what is relevant information. And then these are applications that we're going to use using relevant information. So we're going to make special pricing decisions, make decisions about dropping a product, product mix and sales mix, and finally outsourcing decisions. So relevant information is information that differs among alternatives. So think about it, we're deciding between option 1 and option 2. So anything that's different between those decisions would be considered relevant, and that could be relevant costs and it could be relevant revenues. Now we also want to mention the idea of sunk costs. Sunk costs, by the way, are never relevant. Sunk costs are never relevant. Sunk cost is a cost, you may be familiar with that term, that has already been incurred and it cannot be changed by any future decision. So let's say you're trying to decide whether you should buy a new car. The cost of your old car would be considered a sunk cost. Now the selling price today of your old car would not. That would be relevant. But the actual cost, the initial cost of your old car would be considered a sunk cost in that case. And then we're also going to make sure that we remember that there is relevant non-financial information, what we'll call qualitative information. And we'll talk about that. It's not actually integrated into our decision making because our decision making is mostly involving numbers. But qualitative information is also very important. Now, let's take a look here at an example of differential or incremental analysis, which is most of what we're going to be doing here. And what differential analysis does is it only looks at the relevant information or the things that are going to change as a result of the decision. It doesn't look at things that are going to stay the same. So here's an example. Imagine you had an income statement that looks like this before, and then these are the things that would change as a result of your decision. And then this is what it would look like after. So there's a lot of information here. Differential analysis or incremental analysis is going to say, okay, we're only going to look at what's going to change. What's going to happen? Our sales will go up 30,000, our variable costs will go up 18,000, so our contribution margin will go up 12,000, etc. Okay? So differential incremental analysis only looks at relevant information, and that is the things that are going to change from one decision to another. Now let's look at an example of relevant information that you can hopefully all relate to. Now, mind you that this is not all necessarily accurate information, but it's an example, okay? So let's say you're deciding whether you want to buy a Honda Accord or a Mazda 6. So here's all the information that you have, all of the quantitative information, and we're going to decide whether each of these is relevant. Now remember, this is really not hard. It is anything that changes that's different from one option to another is relevant. So is the cost relevant? Yes, because it's different between the two of them. So we say yes, that's relevant. Is the miles per gallon that you get driving the car, city and highway, relevant? Yes, it's relevant because it's different, right? The Accord has higher mileage in both cases than the Mazda. Now, is the warranty relevant? Well, the warranty is the same no matter which option you choose. So the warranty is not relevant. We don't need to look at that because it doesn't matter, right? It's the same. Same with the legroom. So we're assuming the legroom is exactly the same between the two. We do not need to look at that. Trunk capacity, however, is different. So we're going to look at the trunk capacity. That's part of our decision making. So when you're all done, you're going to look at the items that are relevant, and those are going to inform your decision. All right, and remember, relevant is anything that's going to change. All right, so let's look at some of the applications of relevant information, starting with special pricing decisions. And the question here is, should the company accept a special order at a price below its normal price? So a customer comes along and says, hi, we'd like to order 10,000 units of your product, and we're willing to pay you $16. And say your normal selling price is $19. So is that a good deal or not a good deal? So the things that are going to be taken into consideration are capacity. So say you have to manufacture those. Well, if you have to give up manufacturing units that you're going to sell at 19, you're certainly not going to do that. That doesn't make any sense, right? But if you have excess capacity, then you would take that into consideration. You're going to look at differential revenues and costs, meaning how much will our revenues go up? How much will our costs go up if we take on this order? Finally, a qualitative question is, what will be the effect on regular sales? Like, will our customers find out? What if our customers find out and they're like, hey, we've been paying 19. Why are you selling it to this guy for 16? All right. So the way you go about doing this is we're going to do differential analysis. You look at the change in revenue. That's a positive number, right? That increases our operating income. New revenue increases our operating income. Look at the change in costs. New costs decrease our operating income. And then you take the revenue minus the costs and you get the change in operating income. Now, if the change in operating income is positive, meaning that this will result in an increase in our income, we accept the offer, and we reject it if it's negative, because that means that our income is going to go down as a result of accepting the offer. All of these, by the way, have separate videos, so please go and take a look at those to help you with some of the details if you need it later on. This is just general. All right, next up we're going to look at dropping a product. So the question is, should the company drop a product or a business segment? Maybe it appears that the product or business segment is unprofitable. We're going to take into consideration, does the product add to contribution margin? Are there fixed costs that are unavoidable if dropped, meaning that they're still going to be there even if we get rid of the segment or the product? Are there fixed costs that are avoidable if dropped? So those fixed costs will go away if we get rid of it. And will this affect the rest of the company's sales? So sometimes one product drives sales for another product, right? And then finally, what will the company do with extra capacity or space, which is another decision. If you have extra capacity, what are you going to do with that if you stop making this particular product? Again, the differential analysis, we're going to take a look at. Now, watch this carefully. If you drop a segment, I remember as a student for some reason finding this very confusing. If you drop a segment, your revenue goes down. Right? You're not going to have the revenue from that segment or that product anymore. So that's a negative number. So your decrease in revenue is negative. Your decrease in costs are positive numbers, right? When your cost goes away or goes down, your income goes up. So you take your minus of revenues, your plus of costs, net them together, and you get your increase or decrease in operating income. And we're going to do the same thing we did before. We're going to say, yes, we should drop the segment if this is positive, because that means when we drop the segment, our income goes up. If this is negative, then we reject it, because what that's saying is when we drop the segment, our income actually goes down. All right, next up are product mix and sales mix decisions. And the question here is, which products should the company emphasize given constraints, such as limited space or production capacity? So what does that mean? That means, let's say you have a certain amount of floor space to show your products. Let's say you only have a certain number of machine hours to manufacture your product, or maybe there's a shortage of a material that you need and you only have a certain number pounds or a certain number of units of direct materials that you can use to make a product. So how do you decide which product to emphasize? And the answer is contribution margin per unit of constraint. Now be careful, you might be tempted to just use contribution margin, but you have to take into account the unit of constraint, because one product might use more of the constrained item than another. So you're looking at contribution margin per unit of constraint, and then your answer is to emphasize the product with the highest contribution margin per unit of constraint. So our final decision is outsourcing decisions, and that's probably something that you're familiar with. Should the company produce a part or a product internally, or should it buy it from another company, outsource it? All right, so we're going to take into consideration the variable costs of making the product, the avoidable fixed costs of making the product, and we're going to compare these costs in total to the total cost to purchase it, and then we're going to choose the option with the lower cost. Again, remember that there are videos to help you walk you through some of the details of these, because this is giving you an overview. Okay, so that's all we have for now. You should be all ready to work on your chapter now, and I'll see you in the next video.